the earlier of it will start coming due, after the extensions in 26. And then you've got
Yeah.
more coming due, even more coming due in 27 because that was the peak. What the statistic that I wish I knew, and I don't know, is what proportion of the multifamily housing stock traded in 2021 and 22. Now I know that there was record volume in those years,
Yeah.
but was it 10% of all properties or was it 50% of all properties? Just don't know.
Alrighty, folks, we are in Q4. It is October 10th. I thought it was time we look at our crystal ball, talk 2025, 2026, specifically multifamily. What is going to be going on in the multifamily world? What is going to go on with prices, lending, losses, growth? Who knows? We're going to have this conversation with Mr. Jonathan Twomley. So, Jonathan, when I talk multifamily 25, 26, what are the first kind of things that jump out to you that might be topics to run down?
Yeah, well, I think there's still the outstanding supply issue in a lot of markets, and then the other one is interest rates. I think those are kind of the two big factors that are going to impact the market. You know, what I'm so if you're kind of been following the multifamily market, deal volume just dropped off the table a couple of years
Crazy.
ago. I mean, just vanished because interest rates just made it really difficult for people to make the numbers work when sellers were expecting peak pricing for their properties. So properties are not coming to market, and volume is way down. And the kind of high quality properties are what is transacting right now, and those are attracting a lot of bidders because there's just
Yeah.
not a lot of supply out there to buy. So the market, sustained an initial price decline, um, but we just haven't seen a lot of volume. So where this goes, I think in terms of the volume, I don't see it substantially increasing next
Mm.
year. I mean, people are talking about there being more interest, right? For they're seeing more interest from investors as because the interest rates have gone down, but doesn't translate into a lot more property coming to the market. Where if sellers bought at the top of the market and they're still underwater, or because they're not getting the pricing that they needed in their underwriting to sell, they're just going to hold longer. I think that you're going to continue to see the market kind of bumble along without being a big increase in volume,
Okay.
because I just don't think that the sellers are there, right? And
All right.
so that's one thing.
Yeah,
Um,
it's really interesting because I think the residential market is kind of the same way. It's we're depression level transactions, right? We just posted a 3.86 million annualized transaction number where we used to be up close to six. I'm seeing the same thing in multifamily in my little markets where, maybe the prettiest and the cleanest class A is trading, but class B and class C can't catch a bid. So really what you're saying is that probably continues in 2025. The tippity top still transacts, but not much else.
yeah, I mean, I think so because what's got to happen is NOIs have to catch up to where the market is now. So what I mean by that is you're not getting asset appreciation because of interest rates, right? Interest rates are high, and even though there were cuts, as you and I have talked a lot, the these the mortgage rates for multifamily are based on the long dated treasuries, right? Not the short dated treasuries. And the long dated treasuries have not really appreciably changed, right? And mortgage rates are based off that. So you're not really seeing a lot of mortgage relief. It's a little bit better than it was a year
Yeah.
ago, but it's
Oh
not,
yeah, from a year. Yeah.
it's not like
Well, let's talk about
given
that because
just saying,
yeah,
given the pricing that people like, it's the same lock-in effect that you see with single family housing, right? You've got people who bought at these incredible valuations, right? And the interest rate cuts have not, you know, after all of the hikes, the cuts are not enough to get back to where they
hmm
were. So their
right.
underwriting doesn't work and they can't sell. If they're able to service their debt, they're just going to keep on eking it
That's the
out,
key. That's the
right?
key. Yeah.
if they can service the debt, they just eke it out for longer until they get to a sale price. And what's got to happen is you've got to have enough rent growth, right, and enough NOI growth to that at the
but that
new
that could
higher
that
cap
could be
rates. It
years
could be years, yes. And when you're talking about insurance rates going up and supply, now this is the other thing, right? In a
coming
lot of
online. Yeah.
yeah, in a lot of the markets that were the most popular markets, right, i.e. the Sun Belt, that's where the most supply came on and still coming on. Now,
Yeah. It's
new new
yeah.
permits are way, way down, like they've kind of dropped off the cliff, but you the cycle, it takes 2 years or 3 years for this to kind of play through. There's still record numbers of apartments being delivered. And
Yep.
even though they're being absorbed pretty well, there's still enough of them that uh, that rents you've had negative rent growth or flat rent growth, right? So that what all that means now, everybody's saying, oh well, in 2025, the new supply is going to start to decline. Well, yeah, it will, but it's going to, it takes 2 years for like permits to go to zero,
Mhm.
for new deliveries to go to zero, because they've got all the stuff that's still in the pipeline, right? So it's still going to continue to make rent growth soft. And if you've got these other issues with expense growth, which we've
Yep.
seen, right?
Hmm.
That's even if you've got a little bit of rent growth, you've got to
Yeah.
have more rent growth than expense growth to make your
Well,
NOI grow. So
this is where I think about 25 and 26 is again. Let's remove Class A from the discussion because I think
yeah,
that's already starting to retrade. I don't know how Class B and Class C, and I say this as an owner of Class B and Class C properties. I don't see how these folks can make the numbers work. I don't see how they hold on. I think the only hope they have is extend and pretend. But I think a lot of this short term capital is going to have enough of that. The question I have is do they come due in 25 or they come
right.
due in 26? I think there's a fair chance that the majority of these push till 26, but that is the end. That'll be the 2 year extensions, the 1 year extensions. The short term capital has a clock. They're going to see that there's no hope. I have seen this movie before. These buildings are only going to get worse.
Yeah.
If you are an owner and you are underwater, you are going to do the bare minimum to these buildings, and they are going to go downhill as collateral. So I don't see how this ends well. I just don't know if the party, if you pay the price in 25 or 26, my gut now thinks 26.
Yeah, well, 26 and 27, because if you think about when all that 3-year bridge debt was originated, it was in 21 and 22. And then you've
Exactly. Yep.
got typically 2-year extensions, right? So 5 years.
Exactly. Yep.
And so the the earlier of it will start coming due, after the extensions in 26. And then you've got
Yep.
more coming due, even more coming due in 27, because that was the peak. What the statistic that I wish I knew, and I don't know, is what proportion of the multifamily housing stock traded in 2021 and 22. Now I know that there was record volume in those years,
Yeah.
but was it 10% of all properties or was it 50% of all properties? You just don't know.
Yeah, it's a
Um,
good question. Like you said, I know it was a record. It was a record by a mile, but I don't
yeah,
know the percentage. You're absolutely right.
yeah.
Well, here's the deal. Here's the other. I mean, let's just play this out. You and I are talking about transactions, meaning buyers and sellers, but let's not forget a lot of people went in and refied existing properties that
This is
they
also
owned.
true. Yeah, yeah.
So you don't only have to think about transactions, but how many people levered up, took all the money out. Oh, I have no money in the deal, blah, blah, blah. They're in the same amount of pain and probably have less incentive to stay. If
Well, I was
you
gonna
have
say, yeah,
no capital in a deal,
if they did get all their capital out, then there's a lot less pain
yeah,
in
it's
in
like,
walking away, right?
there you go.
So, but I do think that if we just don't know what percentage of the market, for these older properties in particular was on long-term debt that people bought, put on the properties in 2018, 2019. You know, if you've got 10-year debt from those times, you're doing pretty well right now. Like you've had expense growth, but you're probably pretty happy. And there's a certain number of deals out, there that are just owned outright. People have owned them for a long time. They've paid off their debt, or their debt
Yeah,
is
you
their
know
debt
what?
is really
Actually,
small.
I want to
So
ask you about that because I know in single family there's a number that's often published that 40%, I think the number is 39.6 to be exact, of single family homes are owned free and clear. I have no idea what that is in commercial. I
yeah, I
suspect
don't
it's
either.
not 39.6.
No,
I'm
but
just
I think,
guessing.
but I do think that there are a lot of small owners who just hold the property for a long time and
Sure.
they don't mess around with like cash out refinances and
If you
all
were
this
going to
sort of
wild
stuff.
ass guess it, do you think it's 10%? Like if I told you the number was over, let's say over under 15, would you take the over or the under?
I take the
15%.
under. I take the
Yeah,
under.
me too. Yeah, I would
Yeah,
take the
but I
under.
but I but I think it's
But
substantial
it's
though, the
some.
number of
Yeah,
free
it's
and
some.
clear. Um, that being said, like so we just don't know, like a sort of just circling back, we just don't know what percentage of the overall market is represented by the 2021-22 vintage loans or refinancings,
Yeah,
right? And
it's gotta be 30%, 25, 30%, just a
well,
wild
I guess
guess.
what's the number that it has to be to really impact the market in your view? Like because
I think
because I don't think
I
it doesn't
think
need to be 50%. If it's like 20% of
I think
all the
that's the number.
multifamily in existence,
Yeah, I think
and
if you
it's
have
all coming due.
20%, yeah, if you have
Yeah,
20% of the stock that's impaired,
yeah,
that's going to be enough. Because again, the problem I see with this extended pretend is it could end up just like the housing crisis. And
yeah,
again, if you don't know what I mean by that is what happened in the housing crisis is if you let it trickle out early, if you were the first to absorb the pain, you did the best. But what eventually happened is everybody gave up. And then when so and so gave up, they also gave up. And then they gave up. And then they gave up.
yeah,
And then the entire market is impaired. Even if you had a gorgeous house in 2010 in Fresno, California, you were competing with 70% of the listings being short sales or REOs. Guess
yeah,
what? You got less money, even though your house is pretty. That could happen again.
yeah. And it can happen in commercial just the same way it can happen in
Oh, let's
residential,
be
right?
clear. I'm
So
counting on it to happen. I'm setting up my chessboard. I'm being very honest about this. I am setting up my chessboard to have high quality single family homes that I could 1031 out of at a peak, when the federal government gives away free money for first time home buyers, whenever that is. I'll sell at the peak because of artificial price increase. And I'm going to take all that equity into distressed, class B, class C multifamily. I did it before. I'll do it again. That's my chessboard right there.
yeah, I think it's a good game plan. I think I mean, and just like stepping back a moment, like you just there's a there's a pattern that people need to recognize about markets over a very long period of time, which is that, you know, this there was a massive move of retail investors from single family to multifamily as a result of the great financial crisis, right?
Correct.
People
Yep.
got burned on single family, so they all looked around and they're like, "Oh, look, multifamily, it's better." All moved in there, right? And then they bid up the trade so that you took something that was in the previous market because it was overlooked, right? It was safe because it was overlooked because people had good low basis in those purchases. Then everybody piles into that trade, they overbid it, and they turn what was safe into something risky, right?
Mm-hmm.
And then what will happen is then they'll all get burned and they will go someplace else next, right? They'll look maybe they go back to single family. Who knows, right? There's not a whole lot of different options, right? Maybe
Mm-hmm.
you're seeing a little bit of like strip center, like there's suddenly a big interest in strip centers everywhere now, right? So maybe that's going to be the next hot thing, or cold storage, or who knows, right? But you just see this pattern of like the mass of people kind of looking for whatever the next sort of safe thing is, and because they're all working on the premise that it's safe, they get complacent, and then they turn a safe trade into an unsafe trade. And
All I
and you
ever
see this
do
pattern.
is, yeah, I just follow the masses and go the other way.
Yeah,
Get out of the
exactly.
way. Yeah, it's pretty wild. So yeah, I think at the end of the day, for me, I think 2025 is more of the same, kind of to your
I
point.
Yes, absolutely.
But but there has to be a moment that this debt comes due. And right now I'm thinking it's 26.
I think some of it starts coming due in 26. I mean, it just that's when it expires. That's when the extensions run out. So
Yeah.
that's when I think you'll start to see more volume because
But
there will
that's
be
the
bargains.
key.
Like,
You need
well,
it needs to start, because again, historically, it tells me is once it starts, others in this market will see it and then they will go as well. And then that just starts a cascade.
yeah, and you also in this process also requires bargains, right? Like
Yes,
you
has
like
to.
it's not going to like be the case that suddenly everyone's going to move because they see pricing kind of where it was a couple of years ago and they're sort of
Okay.
okay with that. Like
Reversion to the
that's
mean. It's got to
yeah,
go low.
it's gotta it's there's gotta be like real substantial discounts to get money off the sidelines
You
and
know, the
start
other
buying
crazy thing,
again.
Jonathan, is lenders will pull back because they're absorbing all these losses, which will make
Yeah,
prices even go lower. That's how wild this is going to get.
yeah, yeah. I mean, that's the pattern, right? When the lenders
I've
are
been here.
absorbing the
Correct.
losses, they pull back. It gets harder to get loans, and then prices fall as a result. And like that's how the whole thing works, right? So you have to,
Yeah.
the whole people who are out there talking about how well all we need is like interest rates to go down, and then everything will be fine. Like it's not how it
No.
works. It's like I mean, literally, if you think about that 2021, 2022 vintage stuff,
Oh,
you
it's
know, the
garbage.
treasury has to go back to like 2% or whatever it was, right?
Sub
To
one. It was sub
sub
one for a
one.
minute.
Yeah.
Yeah.
It's got to
Yeah.
go down that far. And it's not happening. And
Not
especially
happening.
now,
Not happening.
with like, now all of a sudden, everyone had priced in a 50%, another 50 basis point cut by the end of the year. Now that's all been pulled back. Like everyone's kind of rethinking that again. So maybe there'll be 25, right? But
Yeah.
it's like, this is not this
Yeah.
is not going where people think it's going to go. This is a slot.
Yeah, I look forward to the pain ahead. Again, you and I were calling these stupid deals out. I was seeing stupid deals in 21 and 22. Knew this was coming. I will admit it took longer than I expected. I thought we would see pain 24 and 25. It now feels like late 25, 26, but there will be pain nonetheless.
But
And Jonathan, we'll be talking every week. Closing thoughts and where they can find you.
yeah, well, the closing thoughts are the bottom of the commercial market last time around was 2012, even though the crisis was in '08, right?
Great
So
point.
these things take a long time to unfold. It's like moving a battleship. It doesn't happen overnight, even though everybody all along was like, oh, it's almost over, it's almost over, it's almost over. It's not almost over. It's going to be a
Yeah,
while.
gonna be a
But
while.
that's going to be some good buying opportunities for you if you're patient. In terms of where you can find me, well, come follow me on LinkedIn or send me a connection request. Happy to engage with you there. I post almost every day. And I've also got my school group, which you can join, get access to all my courses, get access to me a couple times a month. That is at school.com/AIC, which is short for Apartment Investors Club.
And don't forget, folks, he has a playlist on this channel that goes back years. You can find conversations where we turned a $100 million building into 48 million. We talked about his original story. You can go back and watch our first discussion about what he did. So there's lots of value in the playlist. Just look up Jonathan Twomley. Thanks, buddy.
All right. Thank you.